Rather start actually, Roger, and it's good to have you here in person.
Thanks for having me.
With sort of what you're hearing inside the boardroom. You know, you advise many companies, not just on deals, but more in general dialogue in terms of some of their challenges. So, you know, give us a sense into what kind of challenges are mounting for your corporate clients right now.
It's a two-part message, David, from CEOs. On one side, most of them look upon current business conditions for them as okay. On the other side, most of them are quite pessimistic about the medium term, like 2023. And you see that also in some surveys that we've all looked at that are published of CEO attitudes. And there's a very high percentage, I mean, almost 100%, who expect an authentic recession. So okay at the moment, some weakening, of course, in some places, but okay at the moment, but heading into a darker time.
Yeah, well, we see companies, therefore, decide to pull back on certain expenditures, advertising, and perhaps not hire as much or even move into a mode where they're actually reducing workforce. Is that your expectation, and do you think that's going to actually worsen, so to speak, in the coming months?
I think it's a very complicated dynamic on workforce levels because we're still in a period, and especially have come through one, of relative shortage. And so for some employers, there is going to be a tendency to wait longer before you reduce your workforce because you just came through a period where it was hard to get people to come on board. And I think there's a big debate among economists as to whether, for the moment, and it won't last forever, but the structure of the labor market in that one sense is a little bit different. And then people ask whether it's going to take longer in terms of tightening, monetary tightening, for the labor market to soften because of this reluctance to shed workers. I'm not sure if that's going to turn out to be a big phenomenon, but you do hear that.
Is that essentially, do you think, what is driving the message that we heard from Chair Powell yesterday, this idea of maybe a step down to 50 basis points come December? So this idea of maybe smaller hikes, but to a higher rate and staying there for a longer time because of the resiliency of the labor market?
Well, first of all, Morgan, I don't think the Fed has any alternative but to do whatever it takes.
Yeah.
And that if it's going to make a mistake, and nobody's perfect, to be sure it's on the too much side, not the too little side, because this has been a tough year for the Federal Reserve. We all know that, in terms of its having originally misjudged the stubbornness of inflation, and then a little bit later having given rise to some sense of pause or pivot, and neither of those turned out to be correct. So the Fed has backed itself into a bit of a corner in terms of its own credibility, and I think it means that they cannot afford and will not allow themselves to ease off too soon. Now, I wasn't surprised at all by Powell's net message yesterday. What I was surprised by was that markets didn't fully expect it because, number one, there's been no meaningful change in the basic inflation data. I mean, you can point to fragmentary things, but the basic inflation data has not weakened. Secondly, there's been no meaningful change, as we just talked about, in labor market conditions. And the data of the last 48 hours, ADP, JOLTS, et cetera, confirms that. And the Fed is particularly focused on labor markets. And thirdly, as I said, the Fed has no alternative but to be sure if it makes a mistake, it makes a mistake on the too much side. So I'm not sure why people thought there would be a different message from the Fed yesterday, but obviously some did, which is why equities have been selling off and yields have been rising.
Shepard Smith here. Thanks for watching CNBC on YouTube.